Oh, hello. And now for something completely different. It's Monty Bon Squad's Flying Circus. As always, Monty Bon Squad's Flying Circus is brought to you by Wealth Strategies and Management, 907 Main Street in Stroudsburg, Pennsylvania. WS&M LLC and Bon Squad are separate entities from Private Advisor Group, which is and our registered investment advisor. As always, no animals were hurt in the making of this broadcast, but some were in the manufacturing of spam. Well, good evening, everyone, and welcome to another exciting episode of Bon Squad After Hours, also known as Monty Bon Squad's Flying Circus. Is it us, or has there been a great awakening in the fixed income markets over the last week or so? Because we're seeing more and more mainstream financial publications discuss the potential, for lack of a better word, hazards of bond funds. You know, there's been this belief among some advisors and even some wealth management firms that owning a bond fund is like owning a bond ladder. Well, think with a bond ladder, by definition, you have maturities staggered out across the yield curve. With a bond fund, you don't have a single maturity. The fund does. You own an equity bet on those shares. But it seems to be there's more and more realization out there. So for that, we must applaud the media for doing a wonderful job getting the message out. It's been our view that it's the lack of final maturity and unlimited theoretical duration of a bond fund that's a problem. Now we've also seen more and more voices speak out about the potential hazards in the junk bond arena, and that's what we really want to focus on tonight. Over the past several years, investors have been told that this junk debt now that's been issued, junk bonds and to a certain extent loans, have been carry less risk than they did before. This is with salespeople coming through branch offices and speaking with advisors and clients alike, and they're sitting there like, oh yes, this debt is very, very good. It's not really as junk as this CCC credit rating might indicate. Meanwhile, the issuers of this and the underwriters are saying, we have a whole new group of investors ready to buy this junk debt because the Fed has kept rates so low for so long that these investors are desperate for return. So, that's what's been happening out there. And now, people are starting to see what's really going on. It's like all of a sudden a bell went off, and it's like, well, these junk spreads are tight, and if I don't own an actual bond, and investors reduce their holdings in this junk debt or in these junk funds, with a lack of liquidity, there might not be enough bidders on the other side to prevent a price decline. And what happens? Redemptions come in, and the managers have to sell bonds or loans to meet those redemption requests at a certain point. And they sell the ones they can, not necessarily the ones they'd like to. And it starts creating realized losses. Meanwhile, if I have a bond portfolio of bonds that I know and understand, and I have the credits chosen to my risk tolerance, the duration chosen for my needs within that portfolio, and risk tolerance as well, and volatility tolerance, I can ride this out as long as I understand what I own and why I own it. So, this industry has been dumbed down over the last decade, mostly for liability reasons. Basically, they don't want advisors and other professionals sticking the firm's neck out by choosing investments. Well, just put you in a pool of something and let whatever manager do what he or she will. And the problem is they're all flooded into the same assets. and there's not enough liquidity on the outside to prevent a sharp, potentially prevent a sharp downturn. Now, there's been news out the past 2 days that hedge funds and other institutional speculators are now starting to short this junk debt. Well, they probably started shorting it a while back. We saw credit spreads widen. This is concerning because color we're getting from the street is that retail investors, either directly or through managed accounts, are coming in and they're buying high yield bonds. At the same time that the institutions, the aggressive institutions, the speculators are shorting them. So it's probably the case where we have a situation where we have the short sellers selling bonds short to these retail investors, so they're the other side of the trade. So if we do see a correction in junk debt and these retail investors need to sell, well, it'll probably be the same institutional speculators covering their shorts to buy. So what we think, is that, well, we're not sure at Bond Squad how deep a correction might go. And actually, in the upper ranges of high yield debt, we don't think that the correction is going to be that drastic at all. The balance sheets still look fairly healthy, relatively speaking, in the double B area, and maybe even someplace in the single B area. And investors who can hold to maturity probably will be able to, and we're always talking about that. If you have funds, you're an equity investor, you're just betting on bond prices. So, and that's what you chose to do, whether you believe it or not, whether the fund company told you otherwise, whether your advisor told you otherwise. Basically, you own bond funds, you own stock in a portfolio, and a company owns a portfolio of bonds, right? So if you own the bonds, you should be able to get through it. The prices may swing, and that's where we think the problem is, by the way. Not so much that the magnitude of the correction, the severity of the correction will be greater than before, but the rapidity that it happens, and maybe even the rebound could be that much more dramatic. And investors get whipsawed. So they buy into here as the short sellers come in. They sell it short. They knock the prices down. Then as the prices fall, dramatically, retail investors say, "Oh, get me out." So, and the prices drop again, and then the short sellers cover and push the prices back up. Maybe not all the way back up. You see that whipsawing effect. And we don't believe that. Face it, if you're in this business in the last 10 years, you don't know diddly about the bond market, and especially about the high yield bond market. That, if you think you know it, and you think you understand what the fund companies are saying, you really don't. Remember, they're not unbiased. They're trying to sell their product. Okay, that's what's going on here. And we don't think investors understand. They think they own fixed income. You own equity shares in investment companies that are betting on bonds. Well, that being said, they're starting to come out, and we've got some thanks from some of our subscribers who said, "Hey, Tom, you were recommending going into actual bonds for a long time. We've done that. It was great to be able to point to the front page of Barron's last week, saying that, hey, we already moved into actual bonds. We moved out of the bond funds." And you're welcome. We saw this coming. We don't know how bad it's going to be, but really, if you want to juice income, right, then you need to own actual bonds. If you're betting on the price performance of a bond, yeah, then you can use another vehicle. But most investors don't make that distinction. And most wealth management firms, they don't get it. They think the reason to own bonds versus stocks is just for inverse correlations. 90% of the bond market is based on actuarial buying, managing risk, managing liabilities that come due several years out. Insurance companies, pension funds, and whatnot. They're liability based. They're not looking to buy a bond now and sell it for a 3-point profit, 3, 4, 5 months from now. There was we'll say a stupid article in the Journal the other day, which stated that corporate bonds have been a bad investment this year because they're down 0.8, 0.9%. Really? So people go out there buying corporate bonds 5, 10, 15, 20 years out, and they're buying it for the reason to have a trading profit. Well, if you are, then you deserve what you get. but most corporate bonds are being purchased for income and capital preservation purposes, and we're starting to see that. The data from the foreign purchase of U.S. securities, the tick flows, show that more and more foreign entities are buying corporate bonds as opposed to treasuries. Now, treasury is still the focus of like central banks and whatnot, but we're starting to see more foreign buying of U.S. corporates. Right? They're not buying it because they think they're going to buy it at 102 and sell it at 105 in October. They're buying it because they need income. They need to manage their currencies. They need to own something dollar denominated. Our investment grade companies, the balance sheets are pretty good. Maybe some would argue that some of them are as strong as they've ever been, especially the banks. So they're good. They're good risk versus reward for these type of investors. And this is something wealth management hasn't figured out, and it's disturbing because it's beneficial to us because we're already getting people coming to us saying, hey, what about doing actual bonds, both inside our company and outside? But some investors and advisors are just, they don't get it. They don't understand. We've had discussions with advisors, and it's usually the ones that are newer to the business. They went through training where their fixed income training was based on funds. And we even see that at LPL because we're registered there. Their fixed income strategies based on funds. I mean, is this stupid or what? And people are going to get whipsawed by it. And I hope I don't get in too much trouble saying funds yet. I didn't put it in print. I'm not advertising it. It's not solicitation. So if anyone wants to come after me, go ahead. But it's the truth. And, but there seems to be an awakening to this problem. And, hopefully it gets rectified sooner rather than later before this bubble really bursts. But, we see a correction down the road. The economy is not really picking up steam. We're starting to see it plateau here. It's slowing overseas. We were on a dial-in call today, and an online presentation simultaneously given by the Global Interdependence Center, and the speaker was Wells Fargo's chief economist, John Sylvia. And Wells Fargo's forecast is that maybe we have another 50 basis point rise in the 10-year going forward, and we're probably in a 2.25%, 2.5% economy. These are things that we at Bond Squad have said for a few years. The curve probably flattens at lower absolute yields than in the past. We could, again, if you listen to Mr. Sylvia's presentation and you read the slides, and he's encouraged us to share the charts with our clients and our subscribers, you'll see that even Wells is calling for a flatter curve eventually at lower yields, and that this isn't a normal. The economy is structurally different. Inflation is structurally different. Growth is structurally different. So bond yields will be structurally different. And what's interesting about the inflation comment, there were news stories on Bloomberg today, and rightfully so, which noted that the bond market is not pricing in high inflation. Like the tips break even, the 10-year tips break even was 1.836 this morning when we walked in. That means the bond market is pricing in an average inflation rate of 183 basically for the next 10 years. Now that measures headline year-over-year CPI. So headline is below 1 now. So they're figuring that we're going to get to 1.8. That means we could run a trend, a 2 or so for a while, but then back down we come. It was only a few months ago that MPT strategists were saying, oh, you got to buy tips here. You got to buy tips. Inflation's going up. We're going to see inflation go up. And it didn't. You know what? This is normal inflation right now for this economy. All right? And tips prices came back down. We went sour on tips back in late 2012. Sour that we didn't think was an outperforming asset class from then on. Just a good hedge for inflation pressures should they arise within a well-diversified portfolio, bond portfolio. And when we say tips, we mean actual Treasury interest rate protected securities, tips, not vehicles that hold tips. So, that's kind of, that trade is kind of sour. Now, there's been this debate, well, rates will rise as growth picks up. But growth is showing signs of picking up like late last year, but but rates didn't really rise a whole lot, right? They didn't go. In fact, they came down early this year. Some of that's because of a lot of it's because of the German Bund coming down and all that. But basically, long rates move versus inflation. We've said that, and we've gotten criticized for it, and mostly that people really don't know. Just going by what they've been taught in seminars and classes or corporate training. But Bloomberg had an article, in the same article that mentioned tips, they mentioned that long rates, the 10-year yield, the 30-year bond yield, have trended lower on reduced inflation expectations. Wow. So you're telling us that long-term rates move with the rate of inflation? No kidding. We've proved it time and time again. We published charts on it. That's just a fact. So we think that we probably finished the year with the 10-year note below 3%, perhaps 2.5% or slightly lower by the end of the year. We still think the Fed is probably going to tighten later this year. Our base case is still September, 60% chance, 40 in December, but probably almost 100% chance that they do it by the end of the year, unless we see the strong dollar hold inflation down. The strong dollar is the wild card here. It's pushing commodity prices down, which pushes inflation down. It's pushing the price of imported goods down. It's pushing everything down. It's disinflationary at this point. So if the Fed does tighten, it's not going to tighten very much. Now, the New York and San Francisco Federal Reserve banks are out this evening, with comments that their economists still believe that we'll see trend inflation eventually, probably not in the not too distant future. Yes, could we see core CPI hit 2? Maybe. Do we think we see the headline CPI hit 2? Probably not for a while. How about PCE? PCE is going to be very difficult to get any measure of PCE to 2%. Why? One of the biggest upward impetuses on inflation right now has been rents. Rent is a huge part of the CPI calculation. It is a much smaller component of the PCE calculation. So, and PCE is the favored measure of the Fed. It attempts to measure the prices people actually pay. So to get that to 2%, which when the Fed says 2% its target, it's talking PCE, not CPI. That's going to be very difficult in the near future. And not to be political, but the policies coming out of Washington are not positive for growth. Overtime rules, minimum wage rules. 1% of the U.S. workforce makes minimum wage. So you're going to jack those. You're going to jack those wages up. It's not going to, as Keynesians believe, cause other wages above it to go up. It's going to cause those jobs to get replaced, and it's going to be a drag on the economy. Okay, it's not going to cause inflation. It's not going to cause wages to go up across the board. It's going to spur automation. You'll get your productivity growth, but we believe that we might be in peak productivity. But we'll get to that in a second. The other topic we want to discuss is the higher capital requirements on large banks. Yesterday, the Fed said that it's going to raise the reserve capital requirements for large banks. So just as the guys on Wall Street said, the bank's going to make money, net interest margin is going to increase, which it's not if the curve flattens. And relaxing lending standards and maybe the regulators back off a bit, and the banks should do better. Well, the regulators just turned up the heat on the banks. If you're a large bank, more reserve capital. If you don't want that big capital requirement, downsize. So we don't see the banks and lending driving the economy. In fact, the guys at Wells Fargo noted that in the last quarter or so, credit card delinquencies have started to spike up. In their mind, and we don't disagree, that it could be an indicator that we're moving late in the credit cycle. Well, if you're late in the credit cycle, that means you might be late in the economic cycle, or there's a lag, so maybe you're moving towards the late part of the economic cycle. They noted auto loans. Auto loans, there's been an increase, especially in the last couple of years, dependency on low prime and subprime lending, more so than any time in history. And the folks over at Wells think that there's a slippery slope there, that it could get a little out of hand. And, pent-up demand is being satisfied and then some. maybe you got another couple of years, maybe of this strong auto demand, 16, 17 million, SAR. But then what? That could be another bad outcome. Not systemic, not going to be 2007, but it could be bad. And that's the problem. Everybody's using 2006 as a benchmark for what's good and 2007 as a benchmark for what's bad. In truth, 2006 was a positive anomaly. 2007 and 2008 was a negative anomaly. All right, we should not expect repeats of either. Okay, so all these strategies that say, oh, it's still cheaper than it was in 06. Okay, spreads are still wider than they were in 06. Okay, that was an anomaly. That was generational, if not multi-generational. No one should expect to go back to those conditions. So when we look at the higher capital requirements on banks, we have to figure that lending will be done in a more strict manner. And there was a story today on CNBC about interest-only loans coming out. Yeah, but to do that, to get an interest-only loan, you have to have a credit score like 725 or higher, I believe it was, and they judge you on what your payment would be down the road when your payment goes up on an IO, not to where it is now. So yeah, you can get an IO, but you better have sparkling credit. Whereas IOs are usually taken out by people with less than sparkling credit because they're trying to buy too much house for what they're really approved for, and they can't make the payments unless it's an IO. So yeah, it's back, but it isn't back. The risky lending. It's probably not going to be. Now we spoke before of labor regulations. We like to see people get raises when the market demands it. But we're in a situation where businesses can pretty easily, if labor becomes too expensive, and they've done this in the mid-level job sector. That's the area that's been hollowed out, right? With automation, right? And the bulls out there say, oh, well, that's productivity. Productivity always leads to better conditions, more hiring, wage growth, whatnot. All right, that's like saying if I throw a football at a 30-degree angle, it'll go 50 yards. But if I throw it at 45 degrees, it'll go 60 yards. That means if I throw it at 55 degrees, got to go to 80 yards, right? No. We all know that 45 degrees is the optimal angle to generate the maximum distance when launching an object, right? That's scientific fact. Wind resistance, weather conditions notwithstanding, right? But all else being equal, in a controlled environment, 45 degrees gives you the longest distance when you launch a projectile, right? Well, it could be that's true of productivity benefits. We were so unproductive before technology really advanced in the last century that you needed technology and workers to meet the demand. And when you brought the cost of goods down, you increase the demand for those goods, so you need to produce more. And a company might make less per widget, but they could sell 10 times as many widgets before. But again, at some point, productivity benefits start to fade, right? The law of diminishing returns. We might be at the point, and no one knows this, we might be at the point where we're at peak productivity. And by that we mean peak productivity benefits, not peak productivity as far as being productive. So peak productivity benefits mean that by increasing productivity, it ceases to be beneficial and might be detrimental. We might have hit like that. We might have struck that balance where less productivity gains, fewer productivity gains, or less productivity is bad, but more is also bad. We might be at that 45-degree angle. And if you look at how hiring's been going, and you look at wage growth or the lack of it, and you look at the productivity growth or the lack of it, it's kind of pointing to that. Now, this is just a theory we have. We've never been here before, so anything here is theory, but it's something to consider, right? We have to consider that productivity gains might not increase wages, or jobs for that matter. We're in a situation where we're going to have more and more people as the boomers retire receiving benefits, Social Security benefits, Medicare benefits, Medicaid benefits, and such. Right? As the guys at Wells pointed out, all the projections for entitlements were based on assuming a 3% or so growth rate. Well, what if we only grow in the twos? right? We always assume that there'll be X amount of workers to generate tax revenue to pay for X amount of retirees, but we have a slower birth rate, so we're adding, and we have longer lifespans, so we're adding too few new workers into the labor force per benefit recipient. When you consider that the biggest group of people who left the labor force are men between the ages of 25 and 34, and a lot of those have taken disability benefits, that's more entitlements. They're not working. That's fewer people of primary working age contributing to the tax base. So what's the government going to do? It could devalue the currency, and that would be inflationary. But how can you, when everybody else, Japan, Europe, Britain, Canada, are in worse shape than we are as far as entitlements go, especially the Eurozone and Japan, right? So they're going to try to devalue more aggressively than we are. So you can raise taxes. Well, that's going to kill growth. Or you can cut benefits, and that's going to lead to unrest. And then we have more consumers of the retirement age. That's going to reduce the spending power. So, guys, we think we're in low rates for a long time. We think low rates are now the new normal, at least until something structural changes, right? And we don't see anything structurally improving in the near future. So, anyone out there waiting to hear that the economy is really going to snap back and run consistently over 3 or over 4, all they're going to hear is nothing but crickets. Those who understand what's happening and know how to balance credit risk and duration risk and manage their expectations, they can hear this. But, that's up to you. Like I said, Bond Squad can help, WSM can help. Or we have readers who are financial advisors, and, not patting ourselves in the back by saying this, but they tend to be the self-starter ones, the ones who are on the lookout for their clients, who are trying to see down the road more. Hook up with them. Ask your advisor. If you're interviewing a new advisor, say, hey, do you read Bond Squad's publications? Do you talk to Tom Byrne at Bond Squad? If they say yes, at least they're looking down the road. They're not just taking the party line. They're not relying on past performance for future results. They're being forward-looking, forward thinkers, or free thinkers. So that's all we have for this evening. We get from us is no spam, just good stuff. And if you're looking to crown a new Bond King, maybe it should be me here at Bond Squad, because we're not clowns. So anyway, have a great night. Call us or email us. Call us during market hours, which for us starts around 8 o'clock Eastern time. So 8 o'clock Eastern time to 5 p.m. Eastern time, 8 a.m. to 5 p.m. Give us a call, 570-424-1555. You can email us around the clock. We'll get back to you as soon as you can. My email address is thomas.byrne, B-Y-R-N-E, at WS, that's Whiskey Sierra, the word and, A-N-D, M as in Mike.com, thomas.byrne at WSNM.com. Stop in and see us, 907 Main Street, Stratford, Pennsylvania. We will be announcing the opening of a branch office, WSNM will. We are expanding. Stay tuned for that announcement. If you want to join Bond Squad, if you're an advisor, you want to come over and have a strategist in-house that's working for you and your clients, talk to the guys, the guys that run my firm, Dave DeHaan, Kevin Yurko. They can talk compensation with you. I promise you, you'd be pleasantly surprised what WSNM and Bond Squad can offer you. And with that, have a great night. We're going to enjoy some weather now. It's actually not raining here in Pennsylvania, and the temperature's sitting in the 70s. So back to the deck for us. Thanks, and have a great evening. Goodbye.